Hi everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in today. We're continuing our video series on the history of the Federal Reserve, and today we're going to talk briefly about the stock market crash of 1929, which in many ways was a pivot point for the Fed and certainly the country. Now, the bond market drives of World War I, in which bonds were sold to the general public to help finance the war, this really showed stock promoters and security promoters that securities could be promoted, could be advertised to the general public. And there was a huge proliferation of stock ownership among the general public throughout the 1920s. Evidence of this is that in 1920, the country had about 300 stock brokerage firms. And by the end of the decade, it had around 6,000. So there was a huge expansion. The man that really became synonymous with this expansion of stock ownership is a man named Charles Mitchell of the National City Bank. He created a national network of sales brokers to advertise and to sell to the general public. So there was this big proliferation of stock ownership. The Fed kept interest rates very low, artificially low in the early to mid 1920s, in part to help Britain return to the gold standard. So the conditions were set for a stock market boom. Increasingly, participants were buying stocks on margin. Margin refers to the purchase of a stock using money borrowed from the brokerage house itself. And margin actually refers to the portion of the purchase that is equity financed by the buyer. So for example, if you buy a stock with 20% margin, that means that you're putting up 20% of the purchase price and borrowing 80% from the brokerage firm. Now, the brokerage firms themselves borrow from commercial banks in the wholesale money market. It's called the call money market. But this exposed the commercial banking system and the financial system at large to the stock market. Now, the reason why speculators buy on margin is it enhances the gain. So, for example, if you buy a stock with 10% margin and the stock increases by 10%, you've nearly doubled your money. I say nearly because there's an interest expense involved, but you've nearly doubled your money with a relatively small move to the upside. Now, the converse is true. If the stock price goes down, it takes a very small movement to wipe out the equity position of the buyer. Because of that, brokerages require something called maintenance margin. And this means that if the stock price goes down, the buyer would have to put up additional money in order to maintain their equity position. This also means that if the buyer is unable to put up that additional equity, the brokerage house has the ability to take the stock and sell it on behalf of, in order to pay back the loan. Now, in 1928, the Federal Reserve was becoming increasingly nervous about speculation. The belief at the time was that more money going to speculation meant less money that was going to the so-called real economy. And this is part of what's called the real bills doctrine. The Federal Reserve really wanted the money that they were putting into the economy to go towards securities or commercial loans that were arisen in the conduct of trade. So they were very much opposed to money going towards speculation. And as such, they begin to raise the discount rate significantly in 1928. And they do so in 1928, 1929. Now, this does not initially mute the speculation in the stock market. The Dow Jones Industrial Average actually hits a peak of 381 on September 3rd, 1929. This peak, after the crash, this peak was actually not seen again until 1954, so 25 years. But it reaches a peak on September 3rd, and by late September, stocks begin to slide. Now, we should say the stock market crash is not a single day, but there are 3 days that have become synonymous with the crash in a lot of ways. The first is called Black Thursday. This occurs on October 24th. And the stock market drops 11% in the first few hours of trading. At this point, there was a consortium of banks, including JP Morgan and others, that get together to try to prop up the market. They go out and the head of the New York Stock Exchange at the time was a man named Richard Whitney. He went out and bought stocks of different companies to try to prop up the market. The other 2 days were October 28th and October 29th. They were known as Black Monday and Black Tuesday, respectively. And for these 2 days, the stock market collectively dropped another 23% or so. It was after the Black Tuesday that one newspaper very famously had an article called Wall Street Lays an Egg, and that's become in a lot of ways synonymous with the crash of '29. Now, the reason why the crash was so severe in large part was because of the use of margin. It created this selling spiral or liquidity spiral. So as stock prices went down, more stocks were sold in order to meet margin calls, in order to meet that increased maintenance margin required by brokerage firms. That sent stock prices down even more, leading to more margin calls, and this spirals out. So it greatly exacerbates the selling of 1929 and subsequently later. But it was through margin that commercial banks in the financial system are greatly exposed to the stock market. Now, as we'll talk about a little bit later in other videos, the Federal Reserve could have intervened, and they didn't for reasons that I think are still debated somewhat today. But this is kind of the first shoe to drop, as it were, in what became the Great Depression. In the next video, we're going to talk about the bank crises that occurred in the early 1930s that led to a lot of the reforms in both monetary and fiscal policy. Thank you for tuning in. We'll see you next time.